Hello and welcome to our first webinar of the year. My name is Marilyn Wagner and I am the Chief Experience Officer of the Credit Union. So today we have taxation for G4 visa holders. We know everyone's favorite time of the year, taxes, but we're hoping today to make it a lot easier for you, especially for our G4 visa holders with two very amazing, very well educated and very knowledgeable speakers. Before we get started, I just want to go through some housekeeping items. One item is this webinar is recorded, so don't worry, you will receive a recording of this webinar today, maybe in a couple hours in your email. So you can share it with your loved ones, you can review it, you can go over it. Additionally, our two speakers are very welcome to answering your questions. So make sure on the lower right-hand part of your screen, you'll see a Q&A section. Write those, they will go through their presentation, and then they will answer your questions towards the end. I do want to say before we do get started that our new branch is almost ready to be open. If you've been in the IDB building, you'll notice that we've been under construction for about 3 to 4 months, but hopefully in the next couple of weeks, we'll be open and are so happy to be serving our members soon. So our first speaker today is Jose Sobrado. He is the founder and president of MG Capital Partners. And then Dale Mason will be coming in with over 25 years of experience in international tax consultancy. So without further ado, I welcome Jose to the screen and to begin the presentation. Thank you, Jose.
Thank you, Marilyn, for that kind introduction. Hello, everybody. We are very excited to be here in tax season to talk about taxation for G4 visa holders. And we look forward also to answering your questions. So please take a minute as we go along to write them in the Q&A. We will come back to your questions. We will leave time at the end of the presentation to answer questions. Before we get started, just a very brief disclaimer. Of course, the United States tax law is the most complex in the world by far, bar none. So even though nothing in this presentation that we are going to tell you today will be incorrect, there's always rules and there's always exceptions to the rules which may apply to your own specific circumstances. So please do not interpret any of these as tax or legal or investment advice. Seek professional assistance when it comes time to making important decisions. Our agenda today is packed. We are going to talk generally about taxation principles that affect G4 visa holders, but we're also going to talk about tax return filing requirements, common tax return errors, and then, of course, financial planning considerations related to the way G4 visa holders are taxed. So let's start by discussing tax residency. So most people in the world are tax residents of a jurisdiction. Some people can be tax residents of multiple jurisdictions, and some people, very uniquely, G4 visa holders working full-time at international organizations, may be non-residents everywhere in the world. So what does it mean to be a tax resident versus a non-resident? In most countries, tax residents are subject to taxes on worldwide income. That is certainly the case here in the US. If you're a tax resident of the US, you have to declare your income anywhere and everywhere in the world and pay taxes accordingly to the US. What does that mean if you have income also outside of the US? Well, it very well could be that you pay taxes in multiple jurisdictions. You can pay taxes in the US as a tax resident, and perhaps you can pay taxes outside of the US as a non-resident. Now, does that sound like double taxation? Possibly, but usually not. Usually, if you're paying taxes in multiple jurisdictions, you can earn tax credits, foreign tax credits in the jurisdictions where you are a resident. So that in effect, you're not subject to double taxation. People that have income, taxable income in places where they're non-residents, they usually end up paying the higher of the two tax rates, right? Because of these foreign tax credits. Non-residents, on the other hand, as we said, are only subject to taxes on local source income. So if you're a non-resident of the US, which most G4 visa holders will be, then the US is only interested in taxing your US source income that is tied, linked, sourced to the US. So, as I said, most of you G4 visa holders working full-time for an international organization will not be tax residents of the US. This probably means that you're non-residents everywhere in the world, right? You're non-residents, you're not tax residents anywhere. That's very unique. Most people, as I said before, are going to be tax residents somewhere and non-residents everywhere else. Because your days of presence in the US do not count for purposes of tax residency, a G4 working full-time for an international organization, more likely than not, will never become a tax resident. Uh, One of the ways in which one becomes a tax resident of the US is by accumulating days of presence that count towards tax residency. But your presence in the US is very unique. Under the G4 visa, full-time employed for an international organization, those days don't count. And that is the reason why most of you can spend your whole lives here, your whole careers here, and never become tax residents of the US. For tax purposes, you will always be non-residents. And that will be the same also for your dependent spouses and any unmarried children under the age of 21. They also will be non-residents as long as the primary G4 visa holder is a non-resident. The same will be true for their dependents, no matter how many days they spend in the US, or even if they have working authorization. G4 spouses can have working authorization and earn taxable income in the US, but still they would be taxed as non-residents. Their tax resident status will be non-resident. So how does one become a tax resident here in the US? I mentioned briefly that one way could be by spending sufficient days that count towards tax residency. And the other way could be the green card test. Under the green card test, if you ever applied for a green card, maybe when you retired, if you applied for a green card, you would become a tax resident on the first day of presence in the United States with a valid green card. So it's not while you're applying necessarily, it's when you receive your green card and are physically present in the US with that green card. If you receive your green card outside of the US, that wouldn't automatically make you a tax resident. It would be the first day that you return to the country with that valid green card. That is one way in which a G4 could eventually become a tax resident of the US. The other way is the substantial presence test. As I said, your days currently do not count for purposes of this test, but in the future they could. If you retired and you stayed in the US, or if your visa status changed, if you left your employment and stayed in the US under a different type of visa, your days of presence could start counting for the purposes of the substantial presence test. When you accumulate 183 days of presence in the US, days that count, you will become a tax resident. Now, it's not just the days that you spend in 1 year that count. It's 100% of the days you spend in 1 year, plus 1/3 of the days from the year before, plus 1/6 of the days in the year before. So very important. It works out to about 4 months, let's say, on average. So if you are, or maybe you have family members that are visiting the US on a regular basis, this will apply. Days will count under this rule. And even if you spend less than 183 days in any given year, you could still become a tax resident because you have to go back as far as 3 years and count all of those days under this rule. Now, it is possible also that one could meet both tests. In any given year, one could satisfy both the green card test and the substantial presence test. One will be a tax resident in that case on the earliest of the 2 days. One could also be a partially non-resident part of the year, and then resident another part of the year. That's also perfectly fine. Dual status tax residency is something that happens in practice as well. So we said that married G4 visa holders are non-residents, and non-residents can never file a 1040, Form 1040. That's a common mistake we see in practice. If you're a non-resident, you always want to file 1040-NR. 1040-NR is the tax return that a non-resident would file if they had to file any tax return at all. A 1040-NR can never be filed jointly. So a 1040-NR, a non-resident tax return, will always be filed separately. Now, a G4 visa holder married to a US person could also elect to become a tax resident. This is an election. It's not like the previous tests of tax residency, which are either or, either you are a tax resident or you're not. A G4 visa holder married to a US person or any other non-resident married to a US citizen or a green card holder can elect to become a tax resident. This is called the 6013G election. As I said before, if you elected to become a tax resident of the US, it means that the US would be taxing you on your worldwide income. Now, that wouldn't cover your earnings from the IDB, from an international organization. Those would still be non-taxable, but it would cover any other income that you have, any other investments, rental properties, anything else that generates income anywhere in the world would become taxable to you in the US if you elected to become a tax resident under this rule. Now, why would one do that? It might not be beneficial for a G4 visa holder that has income, taxable income outside of the US, but it is beneficial for the spouse. The spouse that is a US person, a US citizen or green card holder, by making this election, can file as married filing jointly, as opposed to married filing separately. And when you do that, when you file taxes as a married individual filing jointly, your tax burden is lower. You have a higher standard deduction and overall generally lower tax rates. So this type of election is beneficial for the US person, doesn't affect the G4 visa holder if their main source of income is the earnings, the salary, the wages from an international organization. So it could be beneficial in some cases. Very important, if you're considering making this type of election, it can only be made once. If you make this election once, you can revoke it in the future to go back to non-resident, but then you wouldn't be allowed to make the election a second time. So when you're thinking about this type of election, planning ahead is important. Consider not just your current circumstances, but also how your situation might change in the future. Because of course, as I said, you can revoke it once, but you cannot make it a second time. So if you're a non-resident and you have income in the US, how is your income taxed? The first thing to understand is if your income is considered effectively connected income or non-effectively connected income. Effectively connected income is income associated with a US trade or business. So that would typically be perhaps rental income from a US property if you choose to make the net election to have that rental income treated as effectively connected with a US trade or business. It would also be wages from a G4 dependent spouse that has employment authorization and earns wages in the US. All of this would be considered effectively connected income. And this is taxed at progressive tax rates, beginning at 10% and going as high as 37%, and some deductions can be allowed. So this is effectively connected income, generally more favorable than non-effectively connected income. Non-effectively connected income is mainly investment income. So if you have investments that generate US source income, that is going to be non-effectively connected income and taxed generally at a flat 30% tax rate without any deductions allowed. But again, that's only if it is income from investments tied to a US source. Typically, it comes down to US dividends. We're going to talk more about this, but it typically comes down to US dividends. Like I said, effectively connected income is, for example, the G4 visa holders, the spouse, the dependent spouse wages. The primary G4 visa holders' wages are, of course, exempt. And I mentioned there's some possibility for deductions, generally limited to state income taxes, charitable contributions. Not many deductions available to G4s, to non-residents. When it comes to non-effectively connected income, investment income, I said that this typically relates to dividends from a U.S. source. Interest income is tax exempt. So if you earn interest as a non-resident from U.S. bank deposits, maybe you own bonds, treasury bonds, corporate bonds, CDs, all of this. Any of these types of fixed income investments that generate interest earnings are non-taxable. Interest is non-taxable to non-residents. Dividends, so if you own equity, if you own shares of companies and you earn dividends from those investments, dividends is what can be taxable if those dividends are from a U.S. source. So if you own shares of U.S. corporations and receive dividends, that is taxable at 30%. On the other hand, if you own shares of companies located outside of the U.S., even if you own them in a U.S. brokerage account, that wouldn't change the nature of those earnings. If those dividends are from foreign sources, they are not subject to taxes in the U.S. Capital gains is another possible type of investment income. If you buy a security at one point and sell it in the future for a higher price, you may realize a capital gain in the year where you make that transaction. Capital gains is another type of earning that is generally non-taxable to non-residents. But watch out, if you're a G4 visa holder, there's a rule that probably applies to you. And that is, if you spend more than 182 days in the calendar year, physically in the US, living and working here, then capital gains become taxable. So in that case, any trading, any investments that you sell during a year that generate a profit will be taxable in the US. And it doesn't necessarily have to be investments that you own in the US. Maybe you own stocks, bonds, mutual funds in an investment account outside of the US. This rule wouldn't make sense if it just applied to the US, because investments can be moved around. So this rule is on a global basis. Again, even as a non-resident who doesn't trigger the substantial presence test, you may still be taxable on capital gains from the sales of stocks, bonds, or mutual funds if you are physically present in the US more than 182 days. So with that said, Dale will come and walk us through real estate.
Thank you, Jose. Hello, everybody. Now we get to talk about the wonderful world of real estate. And one of the greatest tax advantages people have of owning their own home in the United States is something called the principal residence exclusion. It's an exclusion of the gain from the sale of your principal residence, your home. Now, there's a very small number of rules that have to be followed in order to get the exclusion of gain from the sale of your principal residence. And one of them is you must own the home and live in the property at least 2 years out of the previous 5 years prior to the sale. So you look at the sales date, you count back 5 years, and if you lived in the home at least 2 of those years, you can exclude from the gain from the sale up to $250,000. And if you own the property jointly, let's say with your spouse, then you can exclude up to a $500,000 gain, not just $250,000, but $500,000. And the good news is this exclusion of gain from the sale of a principal residence includes people who are U.S. citizens, tax residents, and G4 non-residents. So it includes you G4s on the call today. So make sure you, when looking at your home, realize that any gain from the sale is likely to be fully excluded for both federal tax and state income tax. Next slide, please. Another possibility, instead of owning your own home, is to own a U.S. rental property. As Jose was mentioning, some things are considered effectively connected income with a U.S. trade or business, and that's what a U.S. rental property is if you make what's called the so-called net election. What does this mean? in order for you to take any tax deductions related to the sale of your rental property, if you're a non-resident, you must make what's called the net election on the first tax return that you file that includes that U.S. rental property. It's a strange thing, but U.S. residents automatically get all deductions that are allowed to them on a U.S. income tax return if you're a U.S. tax resident without making the net election. But if you don't make the net election and you are a G4 non-resident or any non-resident owning a U.S. rental property, the IRS can simply not allow any deductions related to that property if you don't make the net election. So make sure you do that. Next slide, please. Now, for both people who own, that are non-resident, who own U.S. real property as their home or as a rental property or any U.S. real estate for that matter, the tax law includes a wonderful provision, not really that wonderful for non-residents, that's called the Foreign Investment in Real Property Tax Act. It's a mouthful, the Foreign Investment in Real Property Tax Act, otherwise known as FIRPTA. What is this? It's a 10% or a 15% withholding tax on the gross sales price from the sale of U.S. real property by any non-resident, including G4 non-residents. Now, as we just mentioned, many people will not owe any tax on the sale of their home if they're non-residents, but there'll still be a withholding tax. Now, this withholding tax will be equal to 10% typically if the home is sold for less than $1 million. If you sell the house for more than $1 million, then it's going to be a 15% withholding tax. So $1,001, you're going to get a $150,000 withholding tax, even though at the end of the day, you may not actually owe any tax because of the principal residence exclusion. So then you have to get the refund of that withholding tax. And there's two ways to go about that. One is a Form 8288B, and the other way is to simply file a tax return for that year on a Form 1040 non-resident tax return. Now, we don't have time to go over those two methods, but just know that there are two methods, and you can Google the 8288B process. It's basically for people who sell their home early on in the year. Then they should probably use the 8288B process to get a refund of their FIRPTA withholding. If they sell the property late in the year, they should probably file the 1040 non-resident tax return. But of course, the non-resident tax return for that year won't come out until January or even sometimes February of the following year. So that's why the IRS gives two potential methods to get the refund back: the 8288B method, early on sales in the year, and the 1040 NR method to get your refund. Next slide, please. So let's talk now about actual tax filing. So for those of you who do have a tax filing requirement that are people who are non-residents, that filing requirement is met if you file the Form 1040 NR, the non-resident tax return 1040 NR. Now, all 1040 NRs can only be filed individually. They cannot be filed jointly with your spouse. So if you have the filing requirement, you're going to have to file an individual 1040 NR. You're going to either have to file, if you're single, as a single status on that 1040 NR, or if you're married, it would be married filing separately. That's the status that you would have. Now, generally, the filing dates are going to be April 15th of the following year, just like U.S. persons. And so just know that for both federal and state, you probably should file your tax returns by April 15th, coming up pretty soon. Now, if you're a G4 dependent spouse, an important thing to note here is that if you file a Form 1040, which is not the correct form, because if you're a G4 dependent spouse, a G4 dependent visa holder, you're going to be a non-resident, and therefore you have to file a 1040 NR. If you file the 1040 resident tax return, when you go up for employment reauthorization with the Immigration Service, they're going to see that you filed the wrong form, and you're going to have to make an amendment to file it on the proper 1040 NR. So if you're a G4 dependent, do not file the form 1040. Next slide, please. So as we mentioned, if you're a G4 and you're a G4 dependent, you cannot file a joint income tax return. That's going to be wrong. As Jose mentioned, the important form to file is the form W8BEN with any financial institution, including the credit union that you do business with. You need to file the form W8BEN. And on the form W8BEN, your permanent address is not your home country address in the foreign country where you used to live, but your permanent address on the form W8BEN should be your U.S. address. And you know, many people ask us, is it okay for me to be, as a G4 visa holder, non-resident everywhere? I'm non-resident in my home country and I'm non-resident in the U.S., so I'm non-resident everywhere. Is that okay? And the answer is absolutely yes, because there is no worldwide government. It's absolutely fine to be a non-resident everywhere. But when you fill out the W8BEN form, you'll note there's a middle section that talks about treaty exemptions. If you're a non-resident in your home country and you're a non-resident in the US, you cannot fill that treaty section out on the W8BEN. It's just not applicable to you. Make sure you renew your W8BEN every 3 years. And if all of a sudden you have withholding taken out, let's say on interest income, that you shouldn't have any withholding taken out on interest income, your W8BEN has probably expired and now you're subject to backup withholding. So just make sure with your financial institution that your W8BEN form informing them that you're a non-resident is up to date. Next slide, please. So we mentioned some of these here. I want to specifically mention the fact that even if you have a loss, if you rent your property, your real estate out to others, and even if you have a loss on that real estate, it's important to note that the U.S. law requires you to file a tax return anyway, even if you have a loss. And it's beneficial to you if you have a rental loss, because that rental loss can be carried forward to future years where you may have income that rental loss carry forward can offset that rental income in the future. And that rental loss could actually reduce your capital gain on the sale of that rental property. And it's important to note that if you sell your U.S. real estate, and FERPTA is going to apply, of course, that withholding tax, it's important to find a good real estate agent and a settlement agent that understands, that has experience with FERPTA. Because I've never had a case where the withholding tax has taken place under FERPTA and the non-resident didn't get their refund back. I've never had a case like that. But what can happen is that if the paperwork is messed up, it can really take an inordinate amount of time to get your refund. So just try to find a good settlement agent that has FERPTA withholding experience. Next slide, please. And now back to Jose.
Dale. And so again, if you have any type of financial accounts in the US, whether it's a checking account, savings account, brokerage account, also insurance products, right? Accounts with insurance companies, life insurance, long-term care, these types of things. The W8BN is very important for you to make sure that your taxes are being done the right way. It's important that you submit a W8BN when you first open an account and regularly, at least every 3 years, because it does expire. They'll mention some of the correct ways to submit a W8BN. You should not be making, number one, you should not be making an address outside of the US. If your legal residence is in the US, that is your address, your place of residence for the purposes of the W8BN. And unless you're a tax resident somewhere else outside of the US, which probably most of you are not, then Part 2 tax treaty section does not apply to you and should be left blank. Again, a lot of the reasons, some of the reasons, one of the main reasons or mistakes that many of the people we talk to on a regular basis, one of those mistakes is not properly certifying their accounts, not going through the W-8BEN process. Now, why is this important? How are your taxes supposed to work if you're a non-resident with U.S. investments? The key is withholding. The key to how you're supposed to pay taxes in the U.S. on your investment income is to have the proper withholding. When you submit a W-8BEN and a financial institution knows that you're a non-resident for tax purposes, they are required to withhold taxes when taxes are owed. This is not only the way it should be, it can also be very convenient for you because it means that if everything is done right, you probably do not have to file a tax return. If there's no withholding and you earn income that is taxable, then you are responsible for filing the tax return, the 1040 NR. So make sure there's a proper W-8BEN on your accounts. Make sure that if you have income that is taxable in the US, then make sure that the financial institution is paying taxes for you. Again, this doesn't apply to interest. It mainly applies to dividends. So if you own shares of US companies and you receive a dividend, let's say you earn $1 in dividends from General Motors, you should see $1 in dividend being paid to your account and 30 cents being taken out and by the financial institution and paid as taxes on your behalf. This will also apply if you own US investment funds. If you own mutual funds or if you invest in ETFs, anything that you earn from a mutual fund or an ETF, whether it's interest, dividends, capital gains, it will be paid out to you. It will be distributed to you. And because a US ETF or mutual fund is a US entity, it will be subject to withholding, right? Any payments you receive from a US mutual fund or ETF, just like dividends you receive from a US stock, should be ideally subject to this withholding, non-resident withholding, and that way you make sure that your taxes are paid. Now, even if you have a properly certified account, there's never going to be any withholding for capital gains, right? And that is because, remember, capital gains are generally not taxed to non-residents, but they are taxable to you because of the special rule, the 182-day rule that applies to taxation of capital gains. So even if your account is certified correctly for non-resident, if you trade, if you sell investments during the year and you have a net capital gain result between January 1st and December 31st, there won't be any withholding. So that's a reason for you to file a tax return, a 1040 NR, and pay taxes on those capital gains. So we won't talk too much about financial planning, but you can probably already imagine some of the things that might benefit you in the long term. If you're planning to stay in the US for some years, a long period of time, financial planning is very important, specific to your situation, specific how your taxes work, specific to your pension, specific to your long-term goals. I mentioned some things regarding investments that are going to be beneficial to most of you. The fact that you can earn tax-free interest, tax-free foreign dividends, the fact that perhaps in the future, if you go on a mission abroad or if you leave the US, any capital gains, any unrealized capital gains that you have in your accounts can be realized without owing any US taxes if you're not meeting this 182-day threshold. All of that can be very beneficial and very useful and very important to the way you plan your financial well-being. Be mindful of things like US-based. Don't be afraid of investing. That's a common mistake we come across, but be mindful of the way you're being taxed, particularly if you're considering things like mutual funds, US-based ETFs. There's going to be some tax inefficiencies there. because, as I said, distributions, payments from US-based investment funds will be subject to taxes, will be subject to tax withholding if your account is properly certified. Otherwise, you will have to file a tax return and pay those taxes because those are considered US source payments. If you're investing in fixed income, treasury bonds, corporate bonds, if those investments are inside of an investment fund, the interest that you earn could be taxable. So consider not doing that. Consider owning individual bonds, individual corporate treasury bonds, so that the interest is non-taxable to you because of your non-resident status. Consider the benefits of your pension when it comes to financial planning. Another common mistake that the people we talk to perhaps make on a regular basis is underestimating their tolerance for risk. You have a very unique pension, very valuable in terms of how much you will earn upon retirement, the fact that it's net of taxes, the fact that it's adjusted for inflation, it has a survivor benefit. All of these conditions are very unique. If you talk to people outside of international organizations, very few people have a pension like this. So your tolerance for risk on your savings and your investments is probably higher than most other people out there. So do not make the mistake of not properly valuing your pension when it comes to your overall financial planning and your tolerance for risk and your ability to make long-term investments, which can benefit you many years down the road, even if they are riskier investments in the short term. So Dale and I are available to consult with you on an individual basis. This is some of the services that we provide: consultations, financial planning, investment management. And we are happy to take calls and schedule consultations with any of you if that's something that may help you. But let's move on to your questions. Most exciting part of our day today.
Absolutely. Thank you so much, Jose. Okay, we start out with a question that's probably better suited for tomorrow's presentation on U.S. persons. It has to do with the foreign tax credit, but I'll briefly answer it. So somebody has a foreign tax credit that they're eligible for in the United States. This is, again, probably a U.S. person, not a G4 non-resident. So they have a foreign tax credit carryover. It means they didn't have enough foreign source income to take all of the foreign tax credit on their U.S. income tax return against their U.S. tax. So what happens is you get a carryover of that foreign tax credit to the following year. And if you have foreign source income in that year, generally speaking, you'll be able to take more of that foreign tax credit. And that's on a Form 1116. Now, the person was asking about how to fill out the worksheet, et cetera. I think the best thing for you to do is either to use a tax preparer, or you can use a computer program, typically the most popular in the United States, TurboTax. It will do these calculations for you, so you don't have to actually fill it, do the calculation with a pencil on a worksheet. So that's for the foreign tax credit. Somebody else asked a good question. We mentioned the fact that for federal purposes, you're a non-resident, but what about for state purposes? So for state purposes, generally speaking, you're going to be a resident for state purposes because DC, Virginia, and Maryland have two criteria for you to become a state tax resident, even if you are a non-resident for federal purposes. The two criteria are whether you've spent at least 183 days in that state or you're considered domiciled in that state. And most people that are working and living around the DC area will have lived more and stayed in that state more than 183 days, or they may even be considered domiciled in that state. So again, for federal purposes, if you're a G4, it's like you're a non-resident for federal, but a resident for state income tax purposes. Let's see, somebody asked a question, and you can chime in on this one too, Jose, whether or not there is a minimum investment income that somebody has in order to create a filing requirement. The answer to this is generally there is no de minimis amount for you to have to file a U.S. income tax return if you're a non-resident earning investment income, except if all of your investment income that should have been withheld upon is withheld upon. So for example, if you invest in a U.S. corporation and they provide you with U.S. dividends, then that would be subject to a 30% withholding tax. If that's all you have, and the broker has withheld the withholding tax, they pay it over to the IRS. Then, if all of your income tax has been satisfied through proper income tax withholding by the broker, then you don't have an income tax filing requirement. If that's all you have is investment income and you're a non-resident. But we have many cases, don't we, Jose, of people thinking that they've told the financial institution that they're a non-resident, but instead it turns out that the financial institution is treating them as a resident and doesn't perform the proper withholding, right?
Yes, for most of you, it won't be enough to just submit a W-8BN, and we usually talk about this as well. There's supporting documents that a financial institution will need to see to support your non-resident status because you have a legal address in the US and you probably also have a social security, and that information is part of your W-8BN. They won't automatically accept your non-resident status without proper documentation. So any W-8BN that you would submit should be accompanied by a copy of your passport, your visa, a letter from your employer, and also usually a personal statement from yourself. So as Dale said, if you only submitted a W-8BN without any of these documentation, most likely your account will not be certified and you will not be subject to the proper withholding.
We have a question that's very, very complicated indeed. Now, Jose and I both mentioned the fact that the U.S. tax system is a very, very complicated tax system indeed. As a matter of fact, it's the most complicated system in the entire world. And we have a question that is with regard to 1031 exchanges for G4s. Now, a 1031 exchange is called a like-kind exchange. Generally speaking, you can exchange a U.S. property for another U.S. property has a higher value through what's called a like-kind exchange. But you need to seek assistance from a like-kind exchange facilitator, a 1031 exchange facilitator, because this is a specialty practice in tax. And again, you'll need to seek assistance from a 1031 exchange facilitator.
Question about tax residency. It says, if G4 visa holder with green card case loses the full-time job at international organization, must they file taxes, even if they don't have a job? So there's two parts to this question. One, it has to do with whether you become a tax resident or not, and the other one is whether you have to file or not. Typically, if you don't have taxable income, if you don't have any income to declare, there's no need for you to file anything. But the other part of this question is that if you're not full-time employed at an international organization, then you could become a tax resident. If you're able to remain in the US, you could become a tax resident under the substantial presence test.
Right. So we have a question with regard to a G4 dependent visa holder that's working for an international organization. And of course, their income is not subject to income tax. And they were wondering whether or not they have to file a US income tax return. Now, there's the tax law, and then there's the immigration law. So for tax purposes, if your income is completely exempt from taxation, which it would be if you're working for an international organization, even if you're a G4 dependent, so you would have no taxable income at all, not even any gross income if you're working for that international organization, and you have no other sources of U.S. income, then you would generally not have to file a U.S. tax return. But that doesn't mean that you don't have a filing requirement for immigration purposes. So you need to talk to your immigration attorney to see whether or not you have to file a U.S. tax return, even though it would have zeros on every space. But you need to speak to your immigration counsel for that.
Is a high-yield savings account exempted for non-residents? Yes, a high-yield savings account will earn you interest, just like a savings, just like a checking account, just like a fixed income security, a bond, and interest is non-taxable to a non-resident.
We mentioned before about the principal residence exclusion, and somebody asked a question about what is the effect of making a capital improvement, a home improvement to the property. Well, that's a good question. So you're able to in order to calculate the gain from the sale that's eligible for the principal residence exclusion, you take your sales price minus your agent's commissions, less your original cost basis, how much you paid for the property, and then add to that any capital improvements that would reduce your gain. So these capital improvements would have to do with, let's say, a remodel of your kitchen, a remodel of your bathrooms, etc. That can be added to cost basis, which would reduce your ultimate gain subject to the exclusion. So little things like little paint here and there, fixing items, repairs are not considered capital improvements and cannot be added to cost basis. So it would have to be something substantial that you could add to cost basis.
So is an inheritance from outside the U.S. taxable, Dale?
So many people don't understand this, but that in the U.S. estate tax taxes the estate of the individual who's passed away, not the person receiving the inheritance. So for this particular question, if you're a non-resident living in the U.S. and you receive an inheritance from a person who lives outside the U.S. and the property or funds are located outside of the U.S., the general rule is going to be your receipt of those funds or property as an inheritance is not going to be subject to any type of estate, income, or inheritance taxes.
And how quickly typically does it take to receive a FERPTA refund?
It depends. During COVID, it could be as long as 2 years. But the IRS has gotten better and better at this, and they've whittled the time down substantially since the COVID era. And right now, I think it's between 6 and 9 months. It depends on which method you use, and when you sell your property will make that determination. But I think you should leave yourself at least 6 to 9 months knowing that you don't have those funds available to you for that long a period.
Here's a good question about short-term consultants working for the World Bank, it says here. So if you're a short-term consultant, the question is whether you're full-time employed or not, right? Depending on the policies of the institution, are you working a full-time schedule or not? That may determine whether your days of presence count. If you're full-time employed, your days of presence do not count. If you're not full-time employed, then your days of presence in the country count, and you could become a tax resident. Now, that wouldn't
Yes.
affect
So I wanted to interrupt for a second. So if your days of presence start counting because you're not a full-time employee of an international organization, that just means that you could become a tax resident, but your income would still be non-taxable if you're considered an employee of the organization. So if you're considered an employee of the World Bank, I think this person asked about the World Bank. If you're an employee of the World Bank, your compensation income would still be tax-free, even though you could become a tax resident. The way to know at the World Bank if your income is subject to taxation is whether or not you receive a tax form, either a W-2 or a 1099. If the organization doesn't give you a W-2 or a 1099, then the organization believes that you're not taxable on that compensation income.
And the next question, is there a minimum threshold for capital gains? As we said before, there is no minimum threshold. So if you have capital gains, net capital gains, it's the sum of gains and losses from January 1st to December 31st. Then if you spent 183 days or more in the US, those capital gains are reportable and taxable.
Somebody's spouse received a work permit, did not work, moved away, now came back. She never filed a 1040 NR, but she didn't have any income. Can this be updated? Can she declare no income? I think you should talk to your immigration attorney about this, because for income tax purposes, if she was a non-resident and she didn't work and didn't make any money working at all, there would be no tax return filing requirement. So I think your question is probably surrounding immigration law and whether or not how she gets a new work permit without having filed a tax return. So yeah, speak to your immigration attorney.
The next questions ask about how to report your address on the W-8BEN. So the W-8BEN is going to ask for your legal address, your legal residence, and that is your home. That is the place where you spend most of your time. That is the place where you store your belongings. That is your legal residence. For most of you living and working here in the US, that is going to be your address in the US. That is different than your tax residency, which is a different part of the W-8BEN, Part 2, and that relates to whether you're a tax resident in a country. Probably not the US, probably also not anywhere else in the world, but some G4s for specific reasons may retain tax residency outside of the US, and that would be reported in Part 2.
We have somebody here who's a G4, and the bank deducted withholding tax since I did not have my situation properly registered, but at the same time, my broker did not deduct taxes for the dividends. Should I file a 1040 NR deducting the withholding tax unduly paid? Yeah, so if your broker either under withheld or didn't do the proper withholding for taxes, then you have an obligation to file a 1040 NR tax return and pay those taxes that are now due.
Do financial institutions give us the W-8 form, the W-8BEN form, when we open an account with them? The answer is no. If you simply go to a financial institution in the US and just report your address here and your social security number, you will be able to open an account as a resident. They're not going to ask you if you're a non-resident. They're not going to ask you to fill a W-8BEN. So you know that you're a non-resident. You should ask for the W-8BEN and submit it accordingly.
Question is, if I became a green card holder, will pension income become taxable? IDB pension income become taxable? Yes. So the IDB pension is a foreign pension, which means that if you are a non-resident when receiving that pension, non-resident of the US, that pension would not be reportable or taxable for US purposes. Now, it could be that you're a G4, you worked all your career at the IDB, you decided that you would leave and go back to your home country at retirement, so you remain a non-resident at all times in the US, then that IDB pension would not be taxable for US purposes, but you may in your home country be taxable on that. So you need to then find out in your home country whether they tax the IDB pension. But as a green card holder, yes, that means you automatically become a resident, and then your IDB pension is taxable.
So if you have an account in New York, as this person is asking, or anywhere in the world, and you own treasury bills or any other fixed income security, the interest that you earn from those investments is non-taxable. Things will be different if you own those investments inside of a mutual fund or an ETF. But if you own an individual bond or CD, anything that pays interest is non-taxable.
And the question is, if someone that's a G4 non-resident inherits property in their home country, is it reportable for US tax purposes? So as I mentioned before, it wouldn't be reportable or subject to US income tax on the inheritance. But now I just wanted to say something about US persons versus non-residents. So if you become a US tax resident, a green card holder or US citizen, and receive an inheritance from abroad, it's still not taxable to you. But if you're a US tax resident, you then have to file an information report called a 3520. Maybe this is what this person is thinking about. Form 3520. But if you're a non-resident receiving an inheritance from abroad, you do not have to fill out the 3520. That's only for residents who received inheritance of more than $100,000.
And Dale, can a G4 benefit from the EV tax credit?
The EV tax credit is not refundable. So if you're a primary G4 and all you have is IDB compensation income that is completely tax exempt, and then you are eligible for an EV tax credit, unfortunately, that's not refundable, so it doesn't do you any good to try to claim it.
Somebody wants to know about how to file and whether a software like TurboTax can help.
TurboTax cannot be filed by a non-resident. So if you're a G4 non-resident, definitely don't use TurboTax. There's a couple other software packages that we know about that some of our clients have used. One is called Sprintax, S-P-R-I-N-T-A-X, Sprintax. And the other one is called Tax Act. But make sure on Tax Act, I think you have the option of filing as a resident or non-resident. Make sure that if you're non-resident, you file the 1040 NR.
Somebody is telling us that they spent 190 days outside of the U.S., therefore less than 183 days inside the U.S. Would capital gains be taxable in that case? No, you do not meet the special rule. So capital gains that you realize from selling stocks, bonds, securities are non-taxable to you.
Assuming they've spent less than 183 days in the calendar year. So you look at this 183-day rule for capital gains on a calendar year by calendar year basis.
Correct.
Hi, everyone. I'm going to jump in here, actually. Thank you. What an amazing webinar. There's so many questions, so thank you to you both for taking those questions. We will be sending to those who weren't answered, we will be sending them both to Dale and to Jose. So they will have an opportunity to answer any questions post this if available. And they do have their contact information. Please contact them. Please get in touch with them. They are amazing. So thank you to you both for doing this webinar. And then tomorrow we have a webinar for U.S. citizens, I believe, and green card holders. So for that, tune in. If you should be able to register within the site. So again, this webinar has been recorded. You will receive an email. That way you can go back and you can take a look at everything again. Take a look at our webinar page. We have a lot of content coming down the path. And then again, if you're in the DC area, please come visit us in the next couple of weeks for our new branch, and make sure you check out our website for all the amazing products and services we have to offer to our member. We are safe, we are sound, and we are secure, and we look forward to servicing all of you. Jose and Dale, thank you for joining us today.
Thank you, everyone. Thank you, Marilyn.
Thank you.
Okay.